Hello and welcome to this week's edition of Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith. If you're seeing this on YouTube, please make sure to subscribe to our YouTube channel so you can hear first when it gets released. If you're looking at it on our website, make sure you sign up to receive the email in the upper right-hand corner of the page each week. Each week we try and provide a little bit of perspective, sometimes some entertainment. And this week we're going to do more of the same with mostly perspective. With all the attention focused on our unbelievable inability for our government to come to some kind of an agreement on a budget and a debt ceiling, the market has recovered from what was at some times looking like the beginning of a sell-off. It seems like the prevailing wisdom was as soon as it sells off, I want to be a buyer. And that turns out to be pretty close to what happened, although I'm sure for many traders, as the market seemed to be breaking down, they were looking around wondering where the buyers were. That's where perspective comes in. There was a fair amount of attention given to the VIX, certainly in our arena of traders, primarily because for many of our services, we were buyers of the VIX a couple weeks ago before it shot up. But also just merely because it's a good measure of fear. Put it in perspective, however, we got up to about the 20 level, which seems to be somewhat of a ceiling for the VIX in 2013, as we point out here. So where's really the fear? It looks like that was about it. So the question is, should that have been it? And from the point of view of just trading the markets, not getting hung up with perhaps the fundamental reasons that could be driving the fear, driving the market down, this week was a good lesson or reminder that a lot of times the markets tend to just trade from one end of a range to the other end of the range, and it's just a question of which range you're looking at. Are you looking at the range on a channel that's upsloped in a price chart? Are you looking at the range of a fear gauge, which is the VIX? Are you looking at the range on a weekly chart or a monthly chart? You want to put all this into perspective. Let the news, bad or good, provide the opportunity to drive the market to one end of the range or the other. So the question you have to ask yourself as the market's falling is, are we at the bottom of a range? Are we near support? And I'm going to point out that from the internals that we look at, we did get to a point where it was a reasonable bottom of a range. On top of that, while you don't see it here, we got to some key moving averages, and we'll cover that later. So each week we look at these indicators, and we look at them in terms of ranges. So the VIX, as I pointed out, got to the top of what has been a relatively significant range for 2003 and has pulled back. The question is that it for the down move? According to the VIX, I'm going to say there's a good chance that it is. For a limited amount of time. Anyway, let's take a look at some of the other indicators. Let's look at the McClellan first, because that's a broad measure of advances and declines. And on a bigger perspective, we can see that while it didn't get completely washed out, the way we typically look at these measures is we want to break down through the limit. In this case, we've got it set to about negative 150, and then see it turn back up before we begin thinking that maybe the bottom has been put in. So while it didn't get totally flushed out, it did touch below that oversold reading. Totally washed out would be down near the 300 level. And once it starts backing, filling back in, moving back up, as long as the price action's positive, we tend to look at it from the standpoint of, okay, we got enough of a sell-off to see a reasonable bounce. We got a pretty reasonable bounce already in the first 2 days, but we'll have to take a look and see how it digests that bounce. All right, but the question is, did we sell off enough to warrant looking at the low from the middle of last week as being a significant low? If I'm looking at the McClellan, just like looking at the VIX, I would say absolutely you've put in a relatively significant low. Now, if we look at a little more of a shorter term measure, that being a 12-day advanced decline and a 5-day up-down volume ratio, I'm going to come to the same conclusion. We didn't get totally washed out, but we're back into the range. We got down oversold far enough, and when we've bounced. In terms of volume, we didn't get totally washed out, but we got to the bottom of the range, and now we're bouncing. Let's look at one more. This is strictly advanced declines. It's the 10-day cumulative. It's another way of looking at how washed out the advanced declines get in the New York. And without beating a dead horse, same picture. All right, so what do we look at from here? Well, let's take a look at the individual price charts. And because you can see from all of these indicators, if we want to come back up to the higher end of the ranges, we've got some travel to do. Fact is that we could do that travel without the price making a new high for the move. So it's not a guarantee that because we bounce from here that we necessarily go to the new high. Let's look for the price action to tell us where we might have some trouble getting to that level. I'm going to start with weekly charts to give, again, some perspective on where we are. And I'm looking at the SPYs in the upper left, and the SPYs in the upper left, the Qs in the upper right, the diamonds in the lower left, and IWMs in the lower right. I want to point out what I think is probably the most important part about these charts. And that is, where did they pull back to in terms of price levels? Don't worry about the moving averages right now. We'll look at those in a second. The Qs just came back into the consolidation from which they broke out a month or two ago. IWMs just came back into the consolidation from a month or two ago. However, the SPYs, the S&P, broke well below that prior high. Okay, they were much weaker, and the Dow really came down to a multi-month, almost a not a low for the year, but almost the bottom end of the range that had been established this year. So the Dow really was the weakest. But that said, if we look at, again, focusing on the bigger ranges, the Dow came down to the bottom. The SPY close, but really more towards the middle of the major range for the year. And if we look at the Qs or we look at the IWMs, there really wasn't a whole lot of damage done. So the market continues on a bigger picture basis, if we look at the broad indexes here, to step higher. Does this mean no worries, we continue to go higher and higher? No, not necessarily, but we don't want to get overly sensitive about all the hype in Washington. The market is telling us that the fear of a default by the U.S. government causing the markets to run into a major bear market swoon just isn't there. Now, you could look at that and say the market has not discounted that event happening, and therefore, if it does happen, it's going to be a major disaster. If you want to make that case, go right ahead from a fundamental point of view, but from a price action point of view, I don't think we've really got a lot to go on to support that. That said, if we get some really negative price action following it, then you can take that position. But until you get some price action that's really negative, I don't think you can make that case. And let's take a look at a couple other indexes that would support the not a whole lot to worry about argument. If there was really a feeling of crisis, gold, remember this is a weekly chart, wouldn't be acting like this. Again, the moving averages are secondary as far as I'm concerned in this analysis. The trend is down, a bounce up that coincided with a rise in fear over the government's inability to come to any agreement. We still haven't had an agreement, and gold heading right back down. The other place to look would be emerging markets. Now, emerging markets are probably more likely to respond to a pickup in confidence, global confidence, and global growth. But for the most part, they really haven't done a whole lot in the scheme of a bigger picture. So I'm looking all the way back to 2012, and it's stuck in a range. It came down recently to the lower part of that range. It's in the middle of the range. If we break out above 45 on EEM, I think it's a really, that's going to be a big heads up to keep an eye on equity markets for a strong run. And until we break down below or down towards the 35 level, I think this is painting a picture of a global economy that's trying to find its footing, and until we get a huge deviation from the direction we're currently going, follow the price action. Follow the price action of our individual markets. But keep an eye on the EEM. The fact that it's creeping back up the way it is definitely interesting, not, aside from the fact that it itself could provide a pretty good trading opportunity if it gets through that 45 level. Finally, let's look at the TLTs, which have had interest rates which have a significant move. Again, I'm focusing on the weekly. It's had a massive move down. That's put a damper on some of the different industry groups within the U.S. For sure. The question is, has it come down far enough to either settle in right here or even bounce? Now, on the weekly basis, I think it's pretty hard to tell. Primarily because if you look at, now let's look at the larger trend here. It has a tendency on this moving average, as I believe the 200-week moving average, to overshoot and hold, and it should be, if I were to put a range around this moving average, I know that's not intended to line right up like that. If I put a range around it, this is a pretty good place for it to hold. More importantly, this isn't such a bad place for it to hold, but it's all really rough. I wouldn't use the weekly right here to necessarily be timing my way into anything. But let's dive into the dailies now. And I think the TLTs is an incredibly interesting chart on the daily because of this pattern. So now we're looking at the 200-day moving average in black. We're looking at the 50-day moving average in magenta. So for the first time in a long time, so TLTs, if you just look at the way they've traded down, bunch of series of lower highs, so lower lows and lower highs until here. Now we swing, we take out this level. So this is very much a bottoming formation, and I would look to this level to be a significant support level. And in fact, it just narrowly held on to that. All right, so between the fact that this level has held, we've got now an upswing as opposed to a downswing for the first time in a half a year. And it's clinging on to a 50-day moving average that is trying to turn in a way that has a very interesting and orderly flagging pattern. Now, I know I could say this about a market at pretty much any time, but this could resolve itself in a pretty explosive way in either direction. It's holding on to the 50. I would imagine that if it breaks down through this level here, it could easily just give up the ghost and shoot for the lows right here, which is going to really hurt the bulls. On the other hand, if this wasn't interest rates, I think it would be a lot easier to look at and say this flagging pattern holding the 50 has a pretty good bullish look if it takes out this level. Now I say if it wasn't interest rates because I know a lot of people, and to some extent myself included, have a hard time believing that interest rates actually have much of a chance of going significantly lower. But if I just look at the charts and not think about the fundamentals that seem to be in favor of interest rates rising over time as opposed to lowering, this chart has an explosive look to it should any momentum on the upside start to materialize. Now, to me, that means a couple of things. They explode higher because their rates go down because there truly is a sense of fear that the equity markets don't seem to be reflecting, or the government shutdown does in fact convert to people feeling that it's going to really crunch the economy, and the weak economy will get hit hard, and that will have an effect on interest rates that would push interest rates lower and TLT higher. Again, getting away from trying to figure out what fundamentally is going to happen, since markets have pretty much ignored any bad news, just looking at the charts, this chart I think is a really important one to keep an eye on, and your two levels are right above the 104, probably around the 104.50 level, this low from last week, and this trend line from right here. A break of either one of those is going to be something that should have your attention with interest rates and, of course, looking at how it's affecting the equity markets. So let's take a look at the individual equity markets on a daily basis now. The levels I'd be focused on for the SPYs and the diamonds, for that matter. Let's look at those together. Are the highs of August. This high and this high. All right, so these are the diamonds and these are the SPYs. I'd watch out for the markets to hold or be unable to get above those levels. And if they are unable to get above those levels, it's likely to happen as the Qs are trying to break through their highs and the IWMs are trying to break through their highs. Now the way everything sets up here, it looks like the Qs and the IWMs should easily pierce their highs before the Dow gets up here. May or may not happen, and if the IWMs are leading through this level, I think you need to follow the broader index, which is the IWMs, and have more of a bullish position, especially if the Qs get through. But you want to keep an eye on whether or not these other two indexes can get through these levels. If IWMs break out to the upside and the SPYs are unable to get through this level, the diamonds unable to get through this level, and they start to roll over, that's your warning sign. Now we're going to go into this week with a deadline of the debt ceiling deadline, I believe on Thursday. Market's going to be really focused on it. The question really is, most likely I think the market's not really concerned with whether or not there will be some kind of a resolution, but what that resolution is. It's going to be some form of kicking the can down the road, almost certainly, which means the market's going to be left to interpret how poorly the government has kicked the can down the road. Focus less on what the decision actually is and what you think about the decision than on how the market reacts. Don't let the initial reaction sway you. If the initial reaction is overly bullish and we blow through these highs, and then we start to pull back. Remember, the initial reaction is very often wrong. If the initial reaction is overly bullish, you can go with the initial momentum, but use a daily low as your throttle to say maybe this was a blow off. The markets have already rallied they've rallied from the low and from the support of these 50 days and 200-day moving averages. They've rallied based on the fact that they see some kind of compromise coming. So it's too late to buy the rumor, and it's too late to buy the rumor. The news is almost coming out. When it comes out, the question is it a sell the news event or is it a follow the news event? More often than not, the first day is a follow the news event. After that, it's a sell the news event. Let the market guide you. All right. As I've just pointed out, on a weekly basis, the market continues to step up. But the easiest times to have been a buyer have been on the pullbacks of those steps. We've already had the pullback. So with the pullback now bouncing, the next step is to let the market go the way it's going to go into the news event and then reset. See how the market reacts to the news event and then follow it in the direction that it takes. All right, so that could mean following with tight stops a rising market into the news event. If the market reverses on the news event, don't be surprised. All right. For a daily synopsis of how we're addressing it, make sure you are subscribed to Mish's Daily. You can find that on our site. And until then, I will see you in the next video.